You're listening to the Money Dad Podcast, practical financial and business conversation from a dad who knows money. I'm April Adams, and please welcome my dad, the Money Dad, Robert Adams. Well, I'm not trying to date this episode, but this week has been a doozy in the markets.
Amen.
I don't even want to check my portfolios right now.
Well, April, I did check my portfolios, and I cried like a baby. I looked at it, and I said, how can this be? But guess what? It was.
It was.
It was.
Well,
So some of the things that we can talk about is, add to what we have talked about before, is your risk tolerance. And also, what are some things that you can invest in if you do not have the tolerance to look at something one day and see it looks like it just crashed into a brick wall.
mm-hmm.
But the good thing, April, today, the market went up 1,200 points.
I did see that. I even though I don't like to look at it, I did peek and I was doing a little better.
Well, I peek every day because now, fortunately, the percentages have grown over the years, and I peek. I do a lot of peeking.
I peeked at mine. We were seeing some green, so I was getting happier, but I didn't want to dwell too much.
With all jokes aside, you do have to have a certain risk tolerance for what you invest in. Some people, we will use an example of someone that I know, and it's someone that a financial advisor knows because he has about 600 clients and 550 of them feel this way. They will call him and say, the market is down, I want to sell, I'm tired of losing money. Well, one thing that you need to remember, if you are going to invest in the market, and if you do participate in 401ks, which we will talk about later, and you do participate in certain types of funds, you will be in the stock market. And you cannot lose that money until you sell the stock, and you cannot make money until you sell the stock. The rest of it is just a roller coaster ride until the ride stops.
Yeah, and that's a good perspective. That's what I say. Whenever I do invest something, especially in something riskier, I count that money gone because in that way I just
you don't want to be that.
Well, I just consider it that it's not something that I've been using. It's not something that I'm particularly missing. It does make me sad when it's lower, but at the same time, it's not money that I'm living off of, is what I'm saying.
Absolutely. And I'm going to talk about a couple investment types that start with the simplest, and I'm going to come back to what you said.
Well, can we go with what, if you have a very low risk tolerance,
yes.
what's the investment you can make that requires the least amount of risk?
If you want to guarantee the return on your money and the return of your money, then the first thing to do is go to a bank or go to an online bank and look for what they call high-yield savings accounts. Currently, in today's market, you can find a high-yield savings account anywhere between 3.25% to about 4.25%, and as long as you invest $250,000 or less, then that money will be protected. You will get your 4%, and you don't have to worry about anything. But sometimes, if that scary word called inflation ends up being 5 or 6%, then you did not make enough to cover the increases in prices are. But if you have a good bit of money and you want to diversify, there's nothing wrong with setting aside maybe that emergency fund, the fund that you're never going to touch unless you have to touch. It would probably be a great idea to put it into one of those high yield savings accounts. Another way you can invest safely is in something called certificates of deposit, which is a CD. A CD is like a savings account, except it has a time period that you must leave the money in there for, whether it's for 3 months, for 6 months, 9 months, 12 months, 2 years. And if you withdraw that money before that time period, you just lose some of that interest, but you still get your money back. And because you tie your money up for these time periods, you normally can make a little bit more on the CDs. So I do recommend that if you do have cash that you know that you don't want to touch, you don't want to spend, you're trying to build your emergency fund, then a high yield savings account or a CD would probably be the best thing for you to put that money in. But also, do not be scared of the market because of its volatility. You just do not be scared of that. You have to start somewhere.
There have been a few times where the CDs were the same, the glory times whenever the interest rate was so high for your high yield savings accounts that they match CDs. So there have been a few times where I said, why would I want to tie up my money if I can get it get the same thing without being tied up?
Well, that's a great point. You don't.
Yeah.
The only time you would want to get a CD is if you were going to make a higher rate to tie up your money. Other than that, there's no need to get a CD. But you just, I've always liked to tell my stories, April. So here's something that will be very unbelievable for people.
Oh, it's
going to be very unbelievable for Zach.
Story time with Robert.
Because back when we built our first little house, it was in 1980. Well, Jimmy Carter had just lost the election and Ronald Reagan had just gotten elected. But in that little short time period, nothing had changed since inflation was so high and interest rates were so high. We needed a house. Fortunately, we didn't have to borrow but $22,000. I've told the story in another podcast about the house where we didn't even have an HVAC unit. But guess, April, what was the interest rate that we had to borrow money at in 1980 to get that little house? Just take a guess. Zach?
8%?
I'm going to guess about 17, 18%.
21%.
Zach was closer than me.
I knew early 80s were around 20% ballpark.
21%. Now, here's what was fortunate for the people that had money. Guess what the interest rate was for savings accounts?
5?
15%.
I didn't even know that was possible.
Well, that was 4 years before you were born.
Wow. And how much was gas per gallon?
I don't remember.
I can vaguely remember 89 cents per gallon at one time.
Oh, a little sidebar to tell you how things have changed. When I was 15 years old, I remember buying gas for 28 cents a gallon, and it really ticked me off when it went up to 32. It's like, how in the world could that happen?
And now I'm like, if it just stayed at $2.50, I'd be happy.
And let's talk about this a little bit because it has a reason here. I have a reason. But there was also a period there that there was a gas shortage.
Oh, yeah.
And you could not buy gas when you wanted it. If you had a certain tag number, you could buy it on that day. But if you didn't have a certain tag number, you could not buy it on that day. So you had to do a lot of planning to make sure you didn't run out of gas and get stranded on the side of the road. So it ties in to what we're saying here. in life, you need to do some planning, and we've talked about that a lot, because you never know what's going to come up. It could be another, quote, gas shortage. It could be, another time of when politicians don't make the right decisions and you end up having high inflation and have to borrow things at a certain rate. So you always need to try to do some planning to prepare for these things. But getting back to some of the investments, another thing you can do is you can buy government bonds. I'm not going to talk too much about those because I don't like bonds when it comes to that part. Now, in business, I like short-term securities. I think I mentioned in another podcast that we now, with one of the companies I'm involved with, we're buying short-term treasury bills because the rate is a little bit better than these high-yield rates.
Mm-hmm.
But the other good thing that I mentioned in the other podcasts is that now, instead of being $250,000 insured by FDIC, I'm now the entire amount insured by the U.S. government. And then, too, if you ever wanted to do things like that for yourself, I mentioned it again in a prior podcast, that you do not have to pay state taxes on the earnings on those treasury bills.
Okay.
So that will help you have a more effective yield on your money by not having to pay those taxes. Now let's talk about 401ks. Everybody knows how to spell it, but sometimes people still don't know too much about it.
And we'll also say, if you're in a nonprofit, 403B.
Thank you very much for continuing to remind me of that, because I don't deal much with nonprofits.
Well, and I even realized one thing I didn't know, the hospitals, you get 403B. They're supposed to be nonprofit. Because I was looking at a friend's stuff, and I was like, how are you a 403B? She said, we're nonprofit. And I said, that's hard to believe.
Well, they are very, very similar, but here's the two basic types. We're not going to get into a whole podcast on drilling down to everything about a 401k. But a 401k allows you to take money out of your check, and then it gets deposited into an account that you get to pick that has something in it called mutual funds. All a mutual fund is a group of stocks. For example, a fund that I'm in now contains the top 10 stocks of NVIDIA, Amazon, Alphabet, Microsoft, on and on and on. And I picked that fund because I felt like that those type of stocks were going to grow.
Mm-hmm.
Now, when that money comes out of my check, that money's still mine that goes into these accounts. There are two ways you can handle your money with a 401k. There is a traditional 401k that where your money is pre-taxed. What pre-tax means is if you're taking $25 a week out and you make $500 a week, then you're only going to pay taxes on $475. And you're only going to pay Social Security taxes on the $475,000. That is what they call the traditional 401k. With traditional 401ks, whenever you get your money out and you retire, all that you've earned and all that you've gained over the years, that's when you pay taxes on that money, because you didn't pay taxes on it when you had it taken out of your check.
So in my 401k, whenever, whatever age that I start taking out of, they're going to tax me on those.
They will tax you on the gains.
On the gains.
And on what you put in. Because they didn't tax you on it when you took it out. That is the traditional 401k. Now, let's say that someone is in the 25% tax bracket. That's a hard decision at that time because there's also something called a Roth 401k.
Or Roth IRA?
Roth IRA 401k.
Okay.
And some companies will include a Roth 401k in their plans. What that means is you take the money out of your check, just like a savings account. It goes into the mutual funds that you pick, that you want it invested in. And when your money grows and the interest on it grows and the returns on it grows, then when you take that money out, you pay zero taxes. The only time you will pay taxes on a Roth 401k is when your company makes contributions to that fund for you, like a match, or everybody's heard of matching this and matching that. Whatever they match, whatever they put in, whether it's profit sharing, whether it's a traditional, you put in 6%, we put in 3%, any of that money that earns money is taxed because you didn't pay taxes on it when you received it. But the Roth IRA is the best one, in my opinion, to do, because if you get into a good fund and you double your money, then you will never pay taxes on that money.
Okay, so you said Roth 401k, Roth IRA. Is that literally the same thing, or are there differences?
It's the same concept. The IRA is personal. The 401k is within the business.
Because I do have a Roth IRA.
Right.
And I don't even put it in mutual funds. It just is a fund of stocks I manage.
Well, then you can do that too. And I do that also, April. I have something within my company called a set plan. And when I take money in that, I invest it into a Charles Schwab account, but I manage those stocks on my own. And that is where I learned a lot about stocks. It's because I took a little bit of money that, when you said earlier, you don't want to invest in something that you know is risky if it's going to cause you not to pay your house payment and your light bill and so forth and so on. So I tried some things. I've had winners, I've had losers. But thank God I've had more winners than I've had losers.
Yeah.
And I've learned a lot along the years by doing that. So, with that being said, if you're ready to start investing in some, and you have some excess, and now you've done all the right things to get you to this point, then take a little bit on the side, try some things, do some research, and try to learn about it. Because that is one of the quickest ways to grow your money, is in the stock market. And to be able to allow your hard-earned money to grow for you. Another thing that you can do outside of 401ks and IRAs and CDs and savings account is real estate. It has been shown that there may be crises sometimes where your real estate prices go down. Here comes another story. A guy I knew at Myrtle Beach had some properties down at a place called Pawleys Island. He had a house down there that had just been appraised in 2006 for $1.2 million. In 2008, that house got appraised for $800,000. He was awfully sick. He thought he had lost everything. But he kept it. He wrote it out. He went through it. And when things came out on the other side, he sold that house because he didn't want to go through it again. But he sold it for $1.4 million. So things happen. And you just have to have the strength, the trust that you will get through it, And you have to develop the patience to get through it, and don't let it drive you crazy because it's a bad time. Because historically, the stock market has recovered. There's no guarantees that it will, but historically, it's always recovered, and it's always done better than any other thing that you can do. But getting back to real estate, if you invest in properties and the demand for housing, demand for a place to stay continues to increase and increase, then the values of all of that is going to increase along with it. And then that's when people sell, and that's when they get a return on that. But it's normally a larger investment.
Yeah, and that involves a lot more. Now, is there a way that I can invest in real estate without having to actually buy the whole property and manage it?
There are what they call real estate investment trust that's like a stock. And when you buy it, they call REITs. And that's a way that if you wanted to put some of your money into real estate, that you would go buy those things. There are exchange-traded funds because out there now, too, that I will roll over into. And I'm not going to get deep
Now,
on defining
exchange-traded funds, that's not just for real estate, though, right?
No, I said
ETF?
I'm bouncing off to another one now. I got past real estate. I'm still trying to stay at 100-foot view.
Okay.
Thank you, though, for keeping me straight. I appreciate that.
I'm just trying to make sure we're all on the same.
I'm glad you're keeping
Same
me all on the
page.
same page.
Because I'm not always.
Now, this is something that your brother would love to talk about. But the other thing that you could invest in is something called cryptocurrency.
Ooh, that's divisive.
Very divisive. One thing I will say is when your brother, who likes cryptocurrency, told me about it years ago, I went to a meeting with him, and I walked out of the meeting, and I said, Michael, what in the world is Bitcoin? And then I said, I can't see it. I can't touch it. I can't feel it. It's nothing but a dream. And that dream has hit $120,000 a coin before. Mm-hmm. And at the time, I could have bought those things for $500 a piece. Well, I hate I didn't buy them for $500 a piece.
We all hate we didn't.
I did.
And some of us hate that we sold it.
I think I sold them at $600 a piece.
Zach's sicker than we are.
Zach would have so much money right now if he would have.
Well, what's the old saying? If and buts were candy nuts, we'd all have a Merry Christmas, wouldn't we? But that's another thing to invest in. But instead of trying to go learn how to buy a Bitcoin, a piece of Bitcoin, there are what they call exchange-traded funds that you can buy Bitcoin. So like the real estate, you can buy a REIT, Real Estate Investment Trust Fund, and then you can put your money into the crypto world without actually going and buying a piece of cryptocurrency, which don't exist.
Well, it does. It exists on servers.
That's right, but you're not going to pick it up like a piece of gold. You're not going to pick it up like a quarter.
But if the building that houses the servers burns down, you're going to lose it.
Absolutely. So there's risk in everything, April. So do not
real
be.
as $1 in a bank.
Yep,
There's
exactly.
there's risk in
Your
everything.
dollars aren't real either.
And you and you made me think of something on one of the first podcasts. Is understand what money is. Money is simply defined. It is what we use right here today in the United States of America to take what we have in money and exchange it for something that we want. That's all it is. And for the people who have more money, they get to exchange more of it for other things. For the people that don't have much money, they can't exchange it for much at all. It might be just the necessities of life. But that also leads me to some things to think about where we have talked about in the past about your attitude, changing the way you think. For parents out there listening, teach your children see how to say this. Try not to protect your kids from the world, but teach your kids how to live in the world, because they're going to have to live in it regardless of how people treat them. And to tie that back to money is when you are talking to them, and we talked about this before, April, don't just sit there and wear it out all the time with an attitude. We can't get this because we don't have money. We can't get this because we don't have that. What do you think they're going to do when they grow up?
Be resentful.
They're going to be resentful. They're going to keep that same attitude, and they're just going to pass it down, and they're going to be defeated, and they may never overcome that. When they go from 10 to 20 to 30, their mindset is still, I can't do this. I can't overcome this. It is so bad. The world is terrible. I'll never be able to do it. So as you go through trying to correct the way you look at how you handle finances, think about your children and how you can teach them to do some of the things that you never did, and take some of these things that we talked about on these earlier podcasts. Like when I said my daddy used to take me down to the bank just to put $5 a week in a passbook savings account when I cut grass and made money. He was just trying to teach me, son, take something out of what you just made and put it in the bank so you can get into the habit of learning how to save. And what scares me today is a lot of parents do not teach their children how to save. They just give it to them. Mm-hmm. Because the kid whines so much. I want this, Mama. I want that, Mama. Daddy, I got to have this. Daddy, I got to have that. Tell me what you taught them by giving them everything to help them learn how to do things on their own when you're not around to give it to them anymore. Mm-hmm. And some kids have grown up, to be in their 40s and their 50s, and then when their parents die or the person that they were holding on to, they're like, why is this happening to me? So as you go through this money process and trying to learn some of the things that you didn't learn before, take some of what you're learning and pass it on to your kids. It's okay to say no.
Yes. No teaches good coping skills, which is really what we're talking about. How do you cope?
Absolutely, April. It's a mentality. Managing money is not a sophisticated thing. It is a coping and how you look at
Coping
things.
mechanism, yeah.
What's that word?
Coping mechanism.
Thank you very much.
So learning how to deal with it is your coping mechanism.
Absolutely. And, today I just see kids that they go get brand new cars. They didn't buy them. They couldn't afford to buy them. Now, unfortunately, my first car was a 64 four-door Ford Falcon for $325 that I got 200 of it from cutting grass, and my daddy loaned me the other $125 so I could have a car when I was 15 years old. Mm-hmm. But I also had to pay him back, and I also had to pay the taxes, and I also had to pay the insurance, because the way he helped me cope and develop my mechanisms is, if you want it, then these are the things that you're going to have to do to get it. A lot of people out there don't want to help their kids cope and develop mechanisms. You like that, didn't you?
Yes.
So what we need to do is not only learn how to do some things yourself because you've been spoiled, but teach your kids how to do things so that they won't be spoiled, and so they will know how to do some of these things and how to invest and how to be able to do something on their own.
Well, I think we covered the basics of investing, and so I think this was a good overview. So if you have any questions about what to invest in, well, not specifically what to invest in, but maybe what might be best for you and your risk tolerance, or have a question about the mechanisms of one particular method, let us know. Go to themoneydadpodcast.com, and we have a form, and you can fill out a little question, and we will address it.
We'll be glad to help you any way that we possibly can.
Thanks for listening to the Money Dad Podcast. Head on over to our website, themoneydadpodcast.com, for more resources and to send in any questions that you might have. Do your homework, and we'll see you next time.